Maria opens her banking app on a Tuesday morning, stares at the number in her savings account, and feels nothing. She's been depositing $50 every 2 weeks for 6 months, and the balance has grown by exactly $300. It feels like progress in theory, but in practice, it feels like watching paint dry on a wall she didn't even want to paint. This is an example of what economists call the psychological challenge of delayed gratification, the human struggle to value future rewards when present sacrifices feel so immediate. Maria knows she's supposed to feel proud, but instead she feels tired, because saving money doesn't announce itself with fireworks or fanfare. The turtle doesn't sprint, it plods, one small step at a time, and the destination feels impossibly far away. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. Savings accounts in modern banking systems were designed in the 19th century as institutional tools to promote thrift among working-class populations who had no access to capital markets. The idea was simple: give ordinary people a safe place to store money, offer a small interest rate as incentive, and allow time to do the heavy lifting. What's happening here is a trade-off between liquidity and growth. Savers give up immediate access to large rewards in exchange for security and modest, predictable returns. In the early 20th century, banks promoted savings through campaigns that framed thrift as a moral virtue, a civic duty, and a pathway to middle-class stability. But the system was built on a quiet assumption that people could tolerate years of invisibility, that they could ignore the siren call of immediate consumption. This pattern appears when financial systems prioritize stability over excitement. The slower the process, the more discipline it requires from participants. By the 1950s, compound interest became the centerpiece of savings culture, a mathematical promise that small, regular deposits would eventually snowball into something meaningful. Economists describe this as exponential growth, but to the individual saver, it feels linear because the early years produce almost nothing visible. The turtle moves, but so slowly that its progress seems like an illusion, a trick of patience rather than a product of effort. And here's the counterintuitive part. The system works precisely because it's slow. If it were fast, it wouldn't be savings, it would be speculation. Maria checks her account again 3 months later, and the number has grown by another $150, $50 per deposit, 3 deposits. She calculates how long it will take to reach $5,000 at this rate, and the answer, 4.5 years, makes her want to laugh and cry at the same time. This moment reveals how the system works. It punishes impatience and rewards endurance, but it offers no emotional support along the way. What's happening here is a behavioral phenomenon economists call present bias, the tendency to overvalue immediate rewards and undervalue distant ones, even when the distant ones are objectively larger. Maria buys a coffee one morning, then another, then realizes she's spent more on coffee this month than she's saved in interest over the entire year. The turtle doesn't judge, it simply keeps moving, but the human behind the turtle starts to wonder if the journey is worth it. Financial advisors often frame this struggle as a failure of discipline, but that framing misses the deeper issue. People aren't bad at saving because they're weak. They're struggling because the system offers no incremental rewards. This is an example of what behavioral economists call hyperbolic discounting, the way humans naturally discount the value of future outcomes more steeply than mathematical models predict. Maria isn't irrational, she's human, and the turtle doesn't care about human emotions. The system rewards those who can endure the silence, the monotony, the years of nothing, but it doesn't acknowledge the psychological cost of that endurance. And here's the uncomfortable truth. For most people, the turtle never finishes the race, not because they quit, but because life interrupts. A car breaks down, a medical bill arrives, a job disappears, and the savings account, that slow-moving fortress of patience, gets drained overnight. 2 years later, Maria checks her account again, and this time the number is different. Not because it's bigger, but because she's different. She's learned to stop checking daily, to stop calculating timelines, to stop comparing herself to people who seem to have wealth appear overnight. This is an example of adaptation, the psychological process where repeated exposure to a stimulus reduces its emotional impact over time. Maria's savings account hasn't transformed her life, but it has done something quieter. It's created a buffer, a small cushion that absorbs minor shocks without catastrophe. Economists describe this as liquidity preference, the value of having accessible cash, not for what it buys, but for the security it provides. What's happening here is a shift in perception. The turtle hasn't sped up, but Maria has stopped expecting it to. She's discovered that the hardest part of saving isn't the discipline. It's accepting that meaningful financial change happens on a timescale that feels wrong to every instinct humans evolved. Humans are wired for immediate feedback: hunt, eat, survive. But savings requires tolerating years of feedback so subtle it's almost invisible. This pattern appears in every system that prioritizes long-term stability over short-term excitement. Retirement accounts, index funds, education savings plans, they all move like turtles. And the uncomfortable insight is this: the system isn't broken because it's slow. It's functioning exactly as designed. And the slowness is the feature, not the bug. Maria looks at the turtle on her screen. It's traveled further than she thought possible 2 years ago, even though every single day felt like it wasn't moving at all. Patience isn't a virtue the system teaches. It's a requirement the system imposes, and the only way through is to stop fighting the pace and start trusting the process. The turtle doesn't need to be fast. It just needs to keep moving, and sometimes that's enough.